Clay Patton on the Rural Radio Network. It has been a wild week in the trade. I think volatile is a good way to describe it. Up and then down and then back to the upside coming here for a Friday, at least in the grains. Livestock are a whole nother story in and of themselves. To try and make sense of all of this as well, to get ready for next week, yes, we've got a WASI right on top of us. We go to Darrell Holaday Country Futures in Frankfort, Kansas. Darrell, what is the best way to start just at the beginning of the week where we really saw a lot of bullish risk-on sentiment that quickly dissolved?
Yeah, that's right. And, we came off of those September 1 stocks numbers last Friday, which created a major move up in the wheat and a significant move down in the soybeans. So we entered the week with that sentiment. And then as you went through the week, it became more evident that OPEC for sure was going to make a cut in oil production. And then when we finally got the news, a lot of times things like that are, buy the rumor, sell the facts, or sell the rumor and buy the facts, whichever way you want to put it. But in other words, the news you get is basically in line with expectation. You don't see much change. Well, the expectation was about a 1 million barrel a day cut, which really would have been a net cut of only about 200,000 or 300,000 given what they've already doing. Well, that didn't happen. They cut at 2 million barrels, which ended up with a net cut of about 1 to 1.1. So that was the backdrop that supported the corn and beans. We saw the big swing up in wheat early. What's interesting about wheat this week is it made that run again above $10 on that December Kansas City wheat contract, which tends to be that's the contract everybody's focused on that spot contract, where it's going, what's the real level out there, and it never could hold it. As a matter of fact, we ended up closing lower on the week, quite significantly lower after the run-up last week. So not holding that. The reason we're not holding it is it is a domestic market only. We just are not exporting in at all. Wheat export sales are terrible. Matter of fact, total commitments, which is basically sales plus shipments, through last Thursday right now are the second lowest for the end of September in 50 years. As a matter of fact, just a little off the worst low, which was in 2006. So that's certainly not good, and we're seeing aggressive export offers out of the Black Sea and out of the Black Sea region, which would be Russia and Ukraine. And, I think the problem is this domestic market has just, and our feed market and everything has just pushed our prices way above those prices. And, we're kind of the one they come to at last resort, or you got to have a real freight advantage or some reason you just do not want to buy out of the Black Sea region, which we know there would be reasons. We're seeing them, and as the whole world trade is lower, just the overall trade, export trade throughout the world is lower, and we're certainly on the back end. But that's also true on the corn side. Same problem. As a matter of fact, our total commitments are 50% of a year ago. We're 30% below the 5-year average on total commitments through the end of September. So none of the numbers are good, except for soybeans. We are up 9% there, but a lot of that was front-loaded. We sold a lot of beans in spring and early summer, so we really haven't seen a very aggressive pace there. So that was the heavy rock on the back of the grain sector, is the poor export numbers, which certainly were confirmed in Thursday's export sales report and all the numbers we've just talked about. But the strength in the energy market was very supportive to corn and beans, and we continue to find a very tight pipeline supply of corn and soybeans, specifically corn in the U.S. and the interior areas. It's an interior-driven market. Ethanol, certainly the margins got better this week when you saw that crude production. When you have crude oil go up $13 and a corresponding 40 to 50 cent jump in gasoline prices, you're going to see the ethanol margins get better, and they certainly did. So they aggressively are coming after the corn. And remember, this is an environment where we're in the middle of harvest, and the one in which farmers have a lot of storage space at this point still remain pretty bullish. So you have to go bid it away from them, and they're doing most of that with the basis, not so much on the futures side of things. But once again, on top of the interior prices and the premiums over the world market, making us uncompetitive in the world or in the export market, especially for corn and beans. We're also seeing the low water levels in the Illinois and the Mississippi rivers, really the lowest levels since 2012. They're kind of exacerbating that problem as it increases the cost of freight, and therefore it pushes our prices even higher or our offers higher. As a matter of fact, some of the sales that's already been made are having a lot of trouble getting to the Gulf in an economic fashion in order to make good on those sales. But those factors we saw. Like you said, a lot of wild swings. Wheat made several trips up and down. I would say 15 to 20 above near that 10 and back down and under pressure, but did close lower. But everything else, the corn was slightly higher on the week, and the beans were lower. The soybeans were actually higher on the week, just slightly, but they did make new lows at midweek. On the week, December corn up a nickel at 6.83. The March corn 6.91, seven higher. November soybeans up 2 cents, closing at 13.67 on that November contract. January contract up 3 at 13.79. December Kansas City wheat down 23 at 9.69. July Kansas City wheat 9.51, 3 lower. The November crude oil up $13.22, closing at 92.64. That's as big a move as we've seen the crude oil in a long time on a weekly basis. Once again, primary driver was the OPEC announced cut of 2 million barrels a day. On the livestock side, they had to grab a hold of the concerns, the economic concerns, the woes, the higher energy, and $13 barrel higher oil is not good for consumer demand down the road. That's certainly a problem. But we had good, solid cash fundamentals. Cash in the south on the Fed cattle up $1. We saw in the north it was 2 to 3 higher, and in the east solidly 2 to 3 higher. So again, we're seeing that type of strength. The wholesale products are firmer, really good demand. But once again, you're probably not going to get this supply bull going in the cattle market. Which we'll see tighter supply. We continue to know those tighter supplies are going to get there, but until you stop the liquidation of females, both on the cows and the heifer side going to the feedlot, because of the dryness in the central southern plains and really the whole entire plains, and then now stretching in the Midwest, but primarily the plains and the lack of feed. Until that changes, and we're assured it's going to change, you're not going to really see that a real strong bull market. But the cash fundamentals certainly better in the cattle market and better in the hogs. So it's all the index kind of stabilized out. We still are over around 6 weeks away from what you would normally expect, the seasonal low in the cash index. But a lot of that drop that is anticipated down to the low 80s or 70s has been built into the December contract, and the October hog contract rallied quite substantially as it got way too big of a discount to that index last week. On the week, October cattle 145.32 up 205. December cattle up $1 at 148.05. October feeder cattle up 55, 174.72. November feeders up $1 at 175.62. October hogs 92.95 up 3.72 on the week, and the December hog contract up 92, closing at 77.15.
And that is Darrell Holaday, Country Futures in Frankfort, Kansas. You can always learn more at their website, countryfutures.com. Do remember, trading futures and options involve risk.